Hey everybody, this is Henry W. Steele. In this video, I'm going to give you a quick explanation on how to draw price levels on your chart derived from the very first trading day of each season. Now these price levels that you get on the chart derived from the first trading day of the season can, or could I should say, help you in looking at the price action during that season. And of course by season I actually mean season of the year, like spring, summer, fall, winter, that kind of thing. So I'm going to show you here on this couple of seasons really quickly on the stock Twitter, the most recent price data here. We're going to look at spring and then summer of Twitter to show you how to do this really quickly. It's actually really easy. So the first thing we need to do is mark the first day of spring, which was, let's see, spring equinox was March 20th, a little after noon. So that is right here. March 20th right there, that big candle, first day of spring. Now, first day of summer, we see was summer solstice was June 21st at a little after 6 a.m. So that's before the markets opened on June 21st. So we're going to call it June 20th as the last trading day of spring. So June 20th right there. Okay. Now this is summer. And let's go ahead and find fall while we're at it. Oops, I actually just closed that. But it was the 22nd of September right here, which is the weekend, of course, Saturday. So the last trading day in summer is Friday, September 21st. So we go right there. So that's the first step. You find the first day of each season. Pretty easy, right? The next step is to count the number of trading days within each season. So this one has 64 bars, and then this one has 65 bars. Now, the first thing we need to do after we find the length of the season is to calculate the median price or the average price of the very first trading day. Now here we had a very big trading range. It was a high of, let's see, 34.95. Subtract the low of 30.61. We get a range of 434. We're going to divide that by 2 to find the middle price and add that to the low of 30.61. And we find that $32.78 was the middle price. So let's go ahead and put a line right there, 32.78. So there's our first one, 32.78. And we see that price came up right here and actually found resistance at that level. But let's go ahead and get the rest of our levels here. It's really easy to do. These 64 bars, we're going to add that number, 64, to our total here of the average price of 32.78. I'm going to put that in the memory, 32.78. And we can't add 64 as 64 points because that will give us a level that's way skewed. I mean, it's way off of where we're going. So we're going to slide the decimal over and make the 64 a 6.4. So we're going to add 6.4 points to that, which is going to give us 39.18 as a price level. So let's configure that. 39.18, we get this price level right here. Then simply add another 6.4. We get 45.58. Configure this to 45.58. And we get another price level up there. I'll go ahead and move this out of our way. I'll move it way down here. This one also, so it's not in our way. There we go. Okay, so we see that these price levels right here are actually relatively significant to the market's price action. Okay, now I'm not saying the market's going to stop on them, turn on them, or anything like that. I'm just showing you that these price levels become important to the market, or can, I should say, become important to the market later on down the road. If we look at the mid price here, 32.78, which right here and then subtract our 6.4, we get 26.38 as a price level, which is right there. So we see that we're right close to it right there. So these are the price levels right there, and you can actually subdivide these by 50%, so it would be half of this number. Now let me go ahead and show you really quickly summertime, which is the season we're at right now. Go ahead and delete this. Summertime is 65 bars. Now let me get the calculator back up. We're going to look at a first trading day. Remember, this was the last trading day of spring, and this is the first trading day of summer, if you'll remember correctly. So we're going to use that. Clear this out. We're going to use the price level from this first trading day of summer. The high was 46.87. We're going to subtract the low of 44.20. We get a range of 2.67. Divide that by 2 and add it to the low price, which was 44.2. So we get an average price of 45.53. So we add that. 45.53. There's that price level. Now, obviously, in hindsight, we can see that nothing has gone up significantly over that, so I'm not going to bother with those price levels. But we can go ahead and take this number and subtract our 6.5. We get 39.03. Which is right there. I think I'm off by almost, well, that was pretty good. Okay, and then we add the next price level down, which we just subtract 6.5. We get 32.53, and that is 32.53, right about there. Oh, come on. That was so close. There we go. So we see that the market, it didn't stop exactly on it, but we see that it's very, very close to it. So these price levels are actually derived from the first day of the season, the average price of the day, the first trading day of the season. But all I'm doing is taking the number of trading days and then using that. I'm basically using it like a square. If a Gann angle, a 1 by 1 Gann angle, we're coming down here, it would cross here at this price level. A 1 by 2 would cross at this price level, so forth and so on. So the reality is that's actually what's going on here. It's just essentially squaring price and time, but using the very first day of each season as the starting point to do so. So hopefully that makes sense. If you have any questions, ask them in the comments below, and I'll try my best to answer them in a timely manner. So this is hwsteele, and I will talk to you in the next video.